Hello, I'm Lance Gunkel, the Managing Director at Severson Striggy. Today I want to share how to protect yourself from financial fraud and recognize red flags when dealing with advisors. Let's consider a real-world example. An advisor, Zachary Flaherty, was accused of misleading 12 clients, primarily elderly individuals in Iowa and Nebraska, while operating through his company, Midwest Senior Solutions. He was recently found guilty of unethical practices. In June of 2024, he was sentenced to 18.5 years in prison, plus an additional 6 months for contempt of court. He exploited his client's trust, resulting in substantial financial harm. Here's what happened and what you should look out for. First, look for overly frequent transactions. During the period of 2017 to 2019, one of his clients, who is identified in court documents as Ms. LM, purchased 12 annuities and surrendered 11 annuities, with those surrendered being held an average of just 13 months. In this case, the advisor made numerous annuity replacements, racking up over $500,000 in surrender fees for his client. Constant policy changes often benefit the advisor, not you. Second, look for promises that seem too good to be true. Another client, this one was identified in court documents as Ms. DM, was promised something called a PMI account with a supposed 10% bonus and high monthly returns of 3%. And this was described to her as being similar to a savings or money market account. Always question returns that seem excessively high with little risk involved. A 36% annualized return on a savings account just won't happen. Third, look for unusual financial arrangements. In this same case, the advisor Flaherty requested checks be made out to an entity under his control, then misusing those funds for personal expenses. Ms. DM made out her $100,000 investment check to Infinity, which was a business entity controlled by Flaherty. He subsequently transferred those funds to his personal account and then on the same day withdrew cash to pay for a $63,000 boat. This was a tactic he used with other clients as well, encouraging victims to write checks to him or one of his businesses with a promise to invest the funds on their behalf. The victims trusted him and his statements, and they wrote him numerous checks. But Flaherty didn't invest the funds on the victim's behalf. Instead, he spent the money on himself, his family, and his businesses. Be cautious if an advisor doesn't use established financial institutions for investments. Investment checks should never be made out to the advisor personally. Fourth, look for signs of a lack of transparency. In the case of Flaherty, he failed to disclose critical details like penalties and surrender periods. His client, Ms. DM, had been using her original annuity to provide her with income to cover her living expenses. Once that annuity was forfeited, and Flaherty put her into a new annuity with a 14-year surrender charge and no income rider, she didn't have access to funds that she needed for her daily living. Annuities are typically long-term investments that can take years to fully vest. If the owner withdraws or cancels the annuity before it vests, the owner may face penalties, taxes, and other fees. A good advisor will ensure that you fully understand every financial decision. Here are a few more key takeaways for you. First, verify your advisor's credentials and ensure they're licensed. You can check with FINRA, the SEC, and your state's insurance division to see whether there are any complaints or violations against your advisor. Second, ask for a second opinion if something feels off. And three, never feel pressured into making a decision on the spot. Your financial security is too important to leave to chance. If you ever have questions or need a second opinion, feel free to reach out to us at Severson Strage. Let's build a future together with a plan that suits your needs.